Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Total Convexity Episode 4 is being recorded on October the 20th, 2023. I'm your host, Henrik Neuhaus. Joining me is my co-host, Jim Wang. I'm glad to return with this fourth episode of our podcast series. In the first episode, we discussed our investment and analytical framework, and we recommend new listeners to review the first episode first. In the second episode, we discussed interest rates and treasuries, and in the previous episode, we discussed the US dollar cycle. So, Jim, what do you want to discuss this week?
Hello, everyone. I'm very happy to return to the new episode. Given our discussion on currencies, the US dollar cycle last time, and also the current geopolitical situation, maybe we can spend a little bit time on gold. What do you think?
Sounds good. That's a great idea, actually. About gold. Well, the renowned economist, John Maynard Keynes, used to say that gold, in the context of finance, is a barbarous relic. Critics point out that gold does not yield anything, has, relatively speaking, only some limited use in niche electronic applications, and there are better materials than gold for fixing one's teeth. So, by and large, gold really does not have any utility other than as a pretty metal for making jewelry. And mining for gold is one of the most unproductive human activities. And in many cases, even the quest for gold actually leads to environmental damage. So, Jim, you do think that gold should be part of a portfolio's strategic asset allocation. Can you explain why? We will then talk about your short-term and intermediary horizon views. Jim?
Yeah, sure, Henrik. So I'm not a gold bug, right? So I can be a bullish and a bearish on gold anytime. And by the way, I agree with all the points you mentioned. I completely agree. I mean, I know there's a lot of explanations why gold has become the choice of money for human being. But I can never understand in reality why so. And I agree with all the things that you have mentioned. But somehow, for some reasons, right, for the thousands of years, human beings have come to use gold as their medium of exchange and the store of value. And by the way, they did not communicate to each other, says, let's just use gold. I mean, it's different cultures from Asian Egyptians, right, to Mesopotamian, to the Indian and the Chinese cultures, and they all come to choose gold. So there's something mysterious about it. But I think for us, we just have to accept as it is. And the central banks, by the way, hold a lot of gold, and I'm sure they are not going to hold a barbarous relic. Now, the gold history essentially is the monetary history, because people, after, like I said, a thousand of years, people has come to use gold as a medium of exchange. And there's a problem with that because it's cumbersome to carry, right? And it's difficult to divide to the very small amount for the small transactions, etc. Right? So gradually, some credible institutions, the banks or the government, they basically saying that have accumulated a lot of gold, right? And then they will issue pieces of paper, and those pieces of paper are claim on that gold. So they will tell you that, look, I have a lot of gold, and it's difficult for you to do the transaction. By the way, here's a piece of paper. Carry this piece of paper, and these pieces of paper are as good as gold. And if you need it, come here, I give you gold. And people come here, exchange paper for gold, and they got gold. So gradually, people will believe in that. After a long time, people forget that the pieces of paper is a claim on the gold. And those credible institutions, government and the banks, etc., right? They realize that actually no one come here to claim for the gold. So therefore, they will issue a lot of papers. And once they issue a lot of papers, then what happened? One day, some people realize, you may not have enough gold. So let's try to give you a paper and give me gold. And if we all come here, right, the government will go bankrupt and the bank will go bankrupt, right? So I'm just describing this is actually how the banks works, right? And the switch between these two is actually the switch between fiat money to gold standard. Okay, so the world has basically rotating between these two regimes for a long period of time. Okay, and you can think about the Roman Empire, right? I think there's a lot of writings about the content of silver in the Roman Empire, and it just gradually diminished and got less and less. And I think in China is a similar thing. In ancient time, the money they use, the precious metal they use is silver, so they have a money note in exchange for silver, right? And so you can see that is a peg to silver. Now, our current monetary regime, I think we mentioned this on the US dollar cycle last time, really started in 1971 when Nixon announced DPEG to the gold. So basically, we were on gold standard right before 1971. And from 1971 until today, well, that's how many years? 50 years, right? Half century. So in the human history, right? Certainly, even in the monetary, history, right? 50 years is really, really short period of time. Okay, and typically when you got off the gold standard, right, you feel free to issue a lot of paper, a lot of credit, right, and the government will do so, and eventually you issue too much papers, and there's not much goods and services. There's not much increase of goods and services, but there is a lot of money, right, paper money, and you all result in inflation and a rapid devaluation. And a lot of time is also coincide with the change of paper reserve currency. So the world actually has been, swing between gold standard to the fiat currency back and forth. But ultimately, every time when you have a fiat currency, it ended up government spending a lot of money and devalue the currency, and then the world actually came back to the gold standard. Now, I'm not arguing we'll come back to the gold standard. Maybe in the future it could happen. But I can see that there's a structure changes that will favor gold in the longer run. Now, like I said, we are not gold bugs, and I think if we review the gold history in the past, and you will find out for some extended period of time, gold may not have performed very well. So here I have this chart here. This is a start from 1970s until today, right? And as you can see, once the Nixon, after Nixon shock, right, starting from 1971, gold price really took off, and that is the first big rally. Okay. And then especially, was doing fantastically well during the high inflationary environment, as everyone knows. And once Powell coming, hiked the interest rate to 20% and killed inflation, and gold has come down. And really from 1980 to year 2000, gold has, basically range bound for 20 years. All right, 20 years is a long period of time, and gold was not really performing. Now, from 2000 all the way to 2011, gold has significant rally, right? I think it's rally from 300 or 280 all the way to 1,000 and 1,950 around that level, right? Almost to 2,000, I think, in 2011. So that was a big move, right? Then after that, we have gone sideways market again. Now, from 2011 until today, right? That's about 12 years, right? We are around that 2000 level again. I think the question that you're going to ask is where the gold is going to go from here. I think that's the objective. That's part of the objective we are going to discuss. Now that is the gold adjusted for. That is a gold in the nominal term, right? And obviously, if you look at the paper currencies, paper money, right? Your purchasing power, you really do not preserve any of the purchasing power from 1970s until today. Now, here is the price of gold adjusted for inflation. Now, the adjust for inflation, gold actually peaked in 1981, and we have never broke out of this peak. Okay, despite of the big rallies in the 2020s, right? From 2000 to 2011, and so we have been in this range for quite a long period of time. Gold obviously compete with different other productive asset classes like equities, and also compete with bond. So let's look at them at the relative performance. So here I have a gold price over the total return of S&P 500. So here is not just a price, but also including the dividends and total return. As you can see, we have, pretty big, upswing, right? Like I said, in 1980s, right? And then it has relentlessly, gold has relentlessly underperformed from 1980s all the way to 2000, right? And from 2000 is really the turning point where the gold has significantly outperformed stocks all the way to 2011, right? If one think about it, from 2000 until today, that's more than 20 years, right? And despite of the zero interest rate, countless of stimulus, the internet, the wonderful things of the internet to improve the productivities, right? And all the advanced technologies. Think about how much technology advancement that we have made, and even AI and everything, right? From 2000 until today, ironically, S&P has underperformed gold, right? Obviously, I picked the peak of a tech bubble, right? But if you can see this chart here, in terms of gold versus S&P total returns, we have not made lower lows of gold. Gold is making higher highs versus the S&P 500. If we turn over here, right? I'm just looking at this chart. If you turn over here, that means that we could have another wave, okay, similar to 1980s. And one have to ask ourselves, what kind of environment would result in that, right? Or the otherwise around, right? And this, I'm not predicting that will become a reality. Another chart that I'm looking at here is gold versus a long-term treasury bond. Again, it's a total returns, right? And you can see there's a similar stories, right? 2000, the gold bottom out versus the total versus long-term bond, and now actually versus the bond, gold is making higher high now. It's higher than 2011. Okay, so one we ask ourselves, what between all these asset classes and what's their roles? Why there's a change of fortunes between all the different asset classes. And I think we discussed this in our analytical framework, where the long-dated treasury bond typically perform very well in the low inflation and the low growth environment. So nominal bond will perform very well, and the stocks will perform very well during the high growth period, right? and especially when the inflation will behave. So high growth, low inflation, right? And gold will perform particularly well in the environment of high inflation and low growth, right? And that is in 1970s, right? In the 1970s, right? So if I look at this, our future, and I can see there is a secular shift that is happening. So we are really talking about the long run, is that the environment that we are facing in the next 10, 20 years may be highly favorable for gold. And the reason for that is because is because of the three factors. One is the de-dollarization trend, and the other one is the intensification of a geopolitical conflict. And then the third one is, I think the world, not just the United States, have a very high level of debt. And also, I expect the inflation to be structurally higher in the long run. And because of these situations, and also I think the physical response will become a predominant policy reaction, and because of a high level of debt, and this physical response has to be monetized by central bank. So because of a high inflation but low growth, I think the real interest rate have to be very low, and that is favorable for gold. If you think about the golden era of a financial asset, really started from 1980s until today, when Paul Volcker killed inflation, and we have relentless fall of interest rate to zero. And now this is changing. I do think interest rate has bottomed out, and I'm talking from a long run perspective. They have bottomed out in 2000, and inflation is likely going to make make a secular shift to the upside. And in that perspective, the tailwinds for the financial asset because of a lower discount rate will become a headwinds for them as the interest rate start to rise in the long run, and that is going to hurt, but that is going to be favorable for the real asset, which is commodities and gold and the real estate. By the way, real estate is highly financialized, so it has a lot of properties, a lot of characteristics as a financial asset. And the commodities is going to be really driven during the inflation environment where the growth is robust on that, and the gold is going to be driven by whether the growth is going to be robust enough during the inflation time period. So we are really talking about this long run, but you know that our short-term views here is, in this secular, this is not a straight line. And back in 2020, we argue that the rates have bottomed out and inflation is set to increase. At time we're thinking about 5%, 6%, and here we go. We got it's even exceeded our expectations. But now we are, from cyclical perspective, now we actually think interest rate is close to the peak, and inflation is close to the peak, and it probably will drop significantly during the recession, and then we will see policy reaction again, and then we will have a higher high of inflation, and we'll have a higher high of interest rate in the long run. So that's kind of the long-term outlook, but we can talk each one of them. Obviously, navigating through this is difficult, and we'll talk about our short-term views. So perhaps maybe we can talk about each of these structure changes.
Sure. So you mentioned de-dollarization right now, and you also touched upon it in our previous episode. Now, you still believe that the dollar will continue to be the major reserve currency, for the foreseeable future. Now, would you elaborate on how gold might benefit from this de-dollarization trend, even if the dollar continues to be the dominant reserve currency?
Yes. So that's okay. I think to take us to this, maybe we can start from the Asian financial crisis. Okay, as you know, the takeaway from the Asian financial crisis is that, emerging markets need to have a lot of FX reserve to weather the downturn, right? Because typically during the booming time, they issue a lot of, a lot of US dollar denominated bond. When the US dollar rise, basically they were shorting US dollars and they have to cover, and they all resulted in the crisis. So the solution for that is you hold a lot of FX reserve, and that's the lessons learned for a lot of emerging market countries. And after that, you can see China was starting to accumulate a lot of reserve. I mean, Saudis has always accumulated reserve, US dollars, because it's denominated in US dollars, right? The oil selling, and the US was their first, the biggest customer. But predominantly it was China, right? So they accumulated a lot of reserves, and mostly in US dollars. I think the first wake-up call is really after the financial crisis. And so they realized that the Fed just print a lot of money. Print $1 trillion within less than a year. And by the way, it will take them, a decade to export their goods, right? In exchange for that $1 trillion of reserve. And then not only you did that, and you did a QE2, you did a QE3, right? I think that's the time to think about maybe we need to diversify our reserve, right? So they start buying the, kind of a U.S. asset and the international asset. And then, and then I think it also caused a lot of I would say a bad press in the developed countries, because they think, oh, China is buying all over the world. And I think they also had some setback buying those assets. And then they say, okay, maybe we just do, we spend the money on the infrastructures, right? Spend money, build the road, build all this. And then I think fast forward, right, in the COVID time, before you realize, right, within a few months, the US print the entire FX reserve for the China, right? so that is mind-boggling, right? And if that's not enough, I think you care about value of your FX reserve, and then secondly, you even care about the security of your FX reserve, right? Because then after the US was using the sanctions, right? As long as for political and the geopolitical purpose. I'm not arguing that is right or wrong. I mean, it is just being done. That Russian, suddenly you find out that your FX reserve is not your reserve, is not your FX reserve anymore. So it's not safe. Not only the value has diminished, and it's not even safe, and may go to zero, right? So that's actually one of the key reasons for the One Belt, One Road. They say, we have built enough infrastructure domestically. Let's just build all over the world. It's much better build a road and everything, rather than you just print $1 trillion and all just confiscate it if we all did something that you don't like. So I think, and then if you think about how do you diversify, so I think that's kind of the trend, right? That's what we're doing. That's the world that has been evolving into. And so if you want to diversify away from the dollar, where can you go? There's really no choice. And because of that, gold is the only choice, right? So that's why the Russian and all the others they have been diversifying. They have been buying gold, and China has been buying gold. So I know in this de-dollarization process, gold is really become kind of alternative reserve asset, and because the gold stock is very small, right, relative to the bond, so even increase a little bit of the buying is going to increase the value significantly. But I think the second, so that's the first implication, right? The second implication is that I do not know what's the gold role in the new monetary system that they're trying to establish. Because as far as I can see here, they are trying to come up with a payment system that is out of SWIFT system. And this is a payment system, whatever they discuss, use the local currency, whatever things they're going to use, I think may ultimately require some credible backing, right? I do not know exact form, and nor do I think everyone have visibilities of this. But it's possible that gold and all the other commodities have some component in terms of backing of the currency, especially from the level from the background that they do not have any credibility, from the economic and the history of a credible history to do that. So I mean, I do not know what's the role the gold is going to play, but I certainly think that if the reserve currency, if the gold priced in the reserve currency, if the reserve currency, if the reserve diversification is away from the current reserve currency, then the gold is going to benefit from that.
Right. Now, and then we have geopolitics, which is a tough topic, fraught with problems. But suffice it to say that the world seems to be heading in the direction of rising conflicts and wars, whether hot or cold wars, and that this is probably a development here to stay. So relate that to the fortunes of gold, Jim.
Yeah. So I mean, I'm optimistic, right? But I did not expect the world to evolve in this way. And I saw the risk, but it seems that the world is heading into more conflict, more confrontation, and then less globalization. And I think Ray Dalio have a book talk about the changing of the world order, and I recommend everyone to read that. And that is a very good and a very well written. And also, it is shockingly. It's shocking in the sense that it's very bleak. If that happens, and I think he assigned about 50% of probability of the World War III. So we have hot wars in Ukraine, and now we have hot wars in Middle East, and we have a Cold War with China, and that potentially can get into the hot wars, and hopefully not. But then if you look at the history, gold has always have this geopolitical premiums, and when there's an increasing conflict and a military conflict, and then people will ask why. And this is the property of gold, one of the property of gold that we described, that if it is paper currency, it's always a claim of credit on somebody. Okay, so it's a form of credit. You do not own that pieces of US dollars. Okay, it's with the good faith of the United States. You hold the reserve, and it can be gone. You hold, and so the sanctions and all this, right, make it gold. We talk about cryptocurrency, we make them attractive, and similarly for gold. So gold is not a credit; it's nobody else liability. You can hold it, you can change it for goods and services, and it will be recognized worldwide. And that's part of the reason during the geopolitics, geopolitical intensifications, and the gold price typically start to rise, and there is a premium for that. And then given the world that we are heading into, and one can argue this geopolitical premium can only increase, not decrease. What do you think, Henrik?
Well, yes, I'm afraid so. I agree with you. So looking back in our previous installment, you mentioned that your long-term structural view is that we're likely in for a long period of higher inflation combined with lower growth, that kind of an environment. And a likely outcome of this type of environment is lower nominal interest rates and even negative real interest rates. And this presumably then should be a great environment for gold, right, Jim?
Yeah, that's right. So we talk about, first of all, we on inflation, and our inflation outlook in the next 1 to 2 years is basically contrary to the longer term views that we have. We actually think from cyclical perspective, in the next 1 to 2 years, the inflation is going to fall, and maybe we'll even have a temporary deflation. But we lay out our structured views on inflation back in 2020 when very few people were talking about it, right? Today, everyone was on these things, and which we completely agree, which are the three major drivers. One is really the supply chain and the delinkage from the Chinese supply chain, and you can call it reshoring, friendshoring, and it will make world more fractured, and it will increase the cost of production. It will by increase the redundancy of the supply chain. And even you argue that you can come up with equally sufficient supply chain with even cheaper kind of productions, which I doubt, like in other countries, which I doubt. Even you think so, that then I still think it will take a long time. And the secondly is that we have a lack of investment in the energy space for a long period of time, and now we have a push into the green energy that requires significant investment. And this transition time period, the energy cost and the commodity price is likely going to go higher in the long run. And thirdly, I think that the MMT is going to become a permanent feature that we're going to have. And I think you will probably say how so, because during the in 2020, so when we talk about the fiscal response, monetized by the central bank, that will be the things will be the authorities' response to the crisis, in the future, and it will repeat. But people may say, okay, then look at it right now, and looks like people realize that this will cause a lot of inflation, and probably not a good thing to do. Central bank is not doing QE, and instead is doing QT, and that is true. So that's why we think follow the sequence is more important than following the destination, because now you have the consequence of inflation, so you want to tighten. Okay, once you tighten, then you will have a problem. Once you have a problem, then you will have to ease again. Okay, and so I think that it will return. It will return. The environment we're going to have, it will return. So just visualize this. I think there's one argument from a lot of people, basically saying the Fed have already realized the zero interest rate is very bad, so they do not want to go back there. They also realize the QE is really bad, say they do not want to do the QE. And they also see some far right, congressmen realize the spending is not good, and it's not good, right? And so they will not do that. And I agree, a lot of intentions, right? But our humans' reaction function will determine that they will do it. And ironically, because you do not want to do that, some market price that in, that will create very tightened, monetary conditions, and it will actually increase the probability you're going to do that in the future. So I know this is convoluted, but let me explain. Let's say the market expects Fed is not going to. Fed is a very clever reaction function. They will tighten until inflation fall, and so inflation will fall, right? And then it will result in the recession. And once the recession comes, the Fed say, we are not going to be like, we are not going to repeat the same thing. We are not going to cut, or we cut very slowly. And because of that, things are gonna get worse. And then they will start to cut, and finally say, okay, let's just cut. They cut to 2%, not enough. Things still continue to fall. They cut to 1%, right? Okay, let's say they do not want to go to zero bound. Okay, fine. You cut to 1%, and and what if the things are still falling and fall? Still, the asset prices continue to fall. The economy is still not doing well. And by the way, at the time, the government is going to spend, because that's the time they are going to spend money, right? And think about it. Even today, they want to spend money, right? With the record low unemployment rate. So once they spend a lot of money, and then you will push up the interest rate on the longer run, because we're talking about there's not much buyers, natural demand for that, as we talked before. And now central bank want to ease because you don't want to go to zero bound, right? And there is so much debt, they will push up the price, right? So what do? You will do the QE eventually because there's no choice. And by the way, at that time, equity go down 50, 60, 50%, unemployment go to 6, 7, 8%, right? And all the action will be justified, right? So you can think about the interest rate go down to 2%, Fed fund rate go down to 1% or 2%, right? And the 10-year go down 2.5%, and the 30-year go to 3%, right? And then they started the QE, and then when the interest rate go to higher like 7, 8%, and the inflation go to for the next high bottom. And by the way, the inflation, everyone think about 2% is the magic numbers, but if we really have a shock, inflation will come down from 4%, 3%, 2%, and it probably will not stop there, and it will go to 1%, 0% as possible, and have a temporary deflation shock. And before you realize, after they have all the fiscal response and monetized by the central bank, and the inflation will come back to 7%, 8%, 10% again, right? So I think that's kind of the potential scenario that we can have. And in that environment, right? Basically, we think about the gold is going to perform very well in the environment that the central bank is unwilling or not able to deal with inflation. So I think the one misconception a lot of people talk about is like, okay, we have high inflation. Look, in the past, I mean, why the gold is not performing? And I would say gold actually performed extraordinarily well. And I also want to say gold is actually overvalued versus the real yield, and we will talk about when we discuss our short-term views, because the gold is not hedged for the inflation, but gold rather is a hedge for inflation when Fed is unwilling to deal with it or unable to deal with it. When you have emerging market, when you have inflation, and the central banks basically are not willing to deal with it, right? So that's why you have a very high, the currency devalue and the gold price go higher. And fortunately, in the United States and in the West countries, and the Fed typically have very credible reaction function, so they are willing to deal with inflation. And the problem is, at a certain point, they will not be able to. Is that because once the tightened monetary policy, result in the recession, and then and the high unemployment rate and the collapse of asset prices, then the priority changes. So the only thing, so that's why gold will typically perform well in a structurally higher inflation but a lower growth environment. And as you can also see, Jim, how do you think the growth will be lower than in the past? And I would say, if we think about the growth is typically driven by the labor force growth and the productivity, right? And we all know the labor force growth is in the whole world is not as robust as before in the DM world, and the productivity is relatively stable. And then what is driving this is a lot of time is this debt cycle, the credit cycle, right? And Carmen Reinhart and they did analysis of the financial crisis. Basically, when the debt to the GDP above 100%, and you typically the economic growth materially, and the incremental usage of debt will not result in higher growth anymore. And I think Lacey Hunt also have extensive writing on this, and basically the increase of government spending can cause temporary economic bump of economic growth, but a lot of spending are waste spending, and they crowded out the private economies, and they are not productive, right? So I do not believe that fiscal spending can result in the long-term sustainable growth, but rather they are damaging for the long-term growth. So if you put these two things together, and that is a cocktail for the performance of gold. And by the way, real interest rate. So the TIPS, inflation-linked bond, right? The TIPS also perform very well. So you can also, and I also think they are attractive asset for the inflation-linked bond. I mean, the only problem with that is, again, inflation-linked bond is a form of claim on the U.S. government. It has the full face of U.S. government. The inflation rate that you're going to get is published, calculated by the U.S. government, right? It can be. I'm not saying they are manipulating, but it can be subject to manipulation, right? So, I would say the high inflation and lower growth environment, and it's typically very favorable for gold. And I think in the long run, in the future, that's likely going to be the environment that we, I would say, have high probability that scenario may stay with us for a long period of time.
Right. Well, Jim, I think you have laid out fairly convincingly the case for why gold should be a strategic allocation in an investor's portfolio, and why you think that in the coming decades, because of the structural shifts that we just discussed, gold may perform an even more important role in an investor's portfolio than it has so far. So just to summarize so far, the drivers for gold going forward in the longer term are de-dollarization, geopolitics, and the high level of debt and structurally higher inflation combined with relatively lower growth. Okay, we get that. But Jim, what's an investor going to do with these insights now?
Yeah, sure. So I think it's really depending on what type of investors you are, what type of horizons, right? And I think if you think about from a long-term portfolio construction purpose, right? And I think the 60-40 portfolio have benefited from the correlation between bond and the stocks, and both of them have gone higher because of falling interest rate, like I have described before. So that that is basically the increase of financial asset. And I would say diversification for them probably is going to be the real asset, which is gold and the commodities. And the gold will particularly perform well during the high inflation and the low growth environment. So I would think that investors should have, strategic long-term, investors should be part of the strategic asset allocation. How big that would be and etc. Obviously is the specific situation of different people, right? And for the short term, intermediary term investors, or if you want to do more tacticals, I think there are some drivers for the gold from short term perspective, and we can discuss on that. And obviously you can do a concentrated bet and etc. And sometimes you can have a less exposure or even short it for some period of time. But I'm just pointing it out that it makes sense to be part of the long-term portfolio.
Okay. So what instruments should investors use? So what we have is physical gold, as in bullion and gold bars. We have paper gold, as in futures and ETFs, and options on these. And then there are mining companies that extract gold. And then, of course, there's always fool's gold, like in NFTs, but let's not waste time on that. So how do you think about these conduits? Physical gold, paper gold, and gold miners? Jim?
Yeah, so we are not here to, we're discussing, kind of, our general views on the investment. We're not, recommending the sponsor, whatever, of any product and things like that. So I would think that, if you have a significant portfolio, if it is institutions, and if you have a very significant size of portfolio, I do think a physical gold can play a role. And otherwise, I also think that ETF, with the physical backings and can be a choice. I'm not kind of doom and gloom guy, and I think that the financial market is going to collapse, and you cannot convert this and get gold. And for the levered and the short-term oriented investors, I think you can also play futures and options, right? So you can make a lot of money and buy physical gold and put them back to the ground. Anyway, I'm joking here, and there is a miners, and obviously you have to know the company you buy, because you're buying a company who produces the gold, so it's a stocks, it's not gold. So like any companies, the revenue is coming from gold, a price, and how much they can sell, right? And the cost is is explorations and the labor cost and the electricity. I don't know all these costs. So it can be lever play at a certain point, at a certain period of time, and we are not. We are, for us, we choose what is good at a particular point of time. But I think investors should be open to all these options. Eric?
Yes, right. So I got that. Now, okay, so you made the point that gold should be part of the strategic asset allocation of any investor's portfolio. But what if I wanted to be more tactical in the short term? If I, like you, may want to make some larger bets on gold from time to time. Can you share your short-term views? Now, I know that your short-term view on gold has shifted quite a lot this year. You were bullish at the beginning of the year and then even bearish for a while. And now you're back to neutral and actually tilting more towards the bullish side of gold. Now, I'm not asking you to predict the path of the price of gold, but rather, how do you value gold? And what is your framework for analyzing the price of gold, which quite frankly seems to be all over the place with a lot of randomness? Jim?
Yeah, that's right. A lot of randomness in the asset price for all the financial asset. But behind that, there are some drivers, for that. And yes, we are turning bullish on gold. So we will explain our short-term outlook, why we come up with that outlook, and what's the uncertainties that we have to deal with. So we can dive that in. Before I do that, I forgot to show the chart, because we're showing the gold in the US dollars for the dollar-denominated investors. I'm showing a chart in Japanese yen because I think the worst offender for the debt monetization of the QE is Japanese, right? So if you look at it, the gold really took off in Japanese yen term in 2000, and it never looked back. And you may wonder why is that? In 2000, Japan was cut interest rate to zero, and then it's really took off, and after consolidated for a period of time, and now you can see, it's I cannot see where this is going to end. But coming back to talk about how we come up with the kind of outlook for gold. I think it's really, we want to see some of the drivers, right? So I think there's three drivers, right? The first driver, we just get out of the way, is the geopolitical premium, right? And that is difficult to assess. It's very objective, right? So if you think things is going to intensify, get worse, that a geopolitical premium will increase. If you think things is going to get better, that a geopolitical premium will compress. And other than that, because gold is priced in US dollars, right? You can also think about the gold in the, one of the drivers is US dollars. So we discussed the US dollar, in our past, in our last episode. And as you can see here, so I have a chart here. So the orange line is the DXY, is the gold, is the dollar index, and so it's inverse. Okay, when this orange line go lower, dollar strengthen. When the orange line go higher, the gold, the dollar weaken. And the white line is a gold price. So we can see here in 2000. Right, and the next decade, gold have a significant rise, right? And that's during the time dollar was depreciating. And from 2011 until today, gold has been strengthening, right? And you can see there is a divergence, right, starting in the 2019 until today, where the dollar has been strengthening, but the gold has continued to rally. And you may ask, why is that? And the other, I think the explanation is really like gold has been rallying not only versus the US dollar, but versus all the fiat currencies. And the US dollar was just strengthening versus the other fiat currencies. Okay, so that's the one key kind of explanation for that. So the US dollar can explain portion of that, but not a lot of that. The real driver, I think, is the real interest rate. Okay, and obviously the real interest rate is associated with dollar strength as well. So typically, when the real interest rate rise in the U.S. dollar strengthen, right? And depending on the rest of the world. So if the U.S. real interest rise faster than the rest of the world, U.S. dollar will strengthen. And well, conversely, if the U.S. dollar if the real interest rate in the U.S. fall, and then the U.S. dollar will weaken, and there's a favorable environment for gold. So if you look at this chart, so as we discussed, there's two kind of a spike, period for the gold to really increase value, right? The first is 1970s, right? And so I have three panels here. The top panel on the top is the gold price. In the middle panel is the real interest rate on forward-looking real inflation, in real interest rate. So basically, it's the yield for the tips, right? It's nominal minus the inflation expectation of the future. So this is a forward-looking, real yield. And I have an orange line here because before 1990s, there's no tips. There's no data here, and so I basically using the nominal treasury yield minus inflation. So you can see here in the 1970s, real interest rate really dropped from 4% all the way down to -4%. Okay. So in other words, the inflation is so high, whatever rise of the nominal interest rate is still not enough to compensate for the inflation. I think this the reason for this is straightforward, is that if you hold gold, there's no yield, and actually there's a carry cost. If you hold a paper money, there is a yield. I mean, the problem is the yield may be less than the inflation, so you're worse off. So when the interest rate become negative, holding gold is actually a positive carry. Now, if you think about the decline of the gold really started in 1981 when the real interest rate significantly increased as the Powell Volcker killed inflation, and this real inflation continued to rise because the inflation fall faster than the nominal interest rate, and so that's the first spike. Now the second one here, as you can see, this trend, of the acceleration of the interest rate of the gold, it really starts from 2000. And if you look at this chart, the real interest rate started a relentless fall. This have start falling starting from 2000. Okay, both on the forward-looking, like implied by the tips, or just using nominal minus whatever CPI reading. And I think this have a lot to do with, as we talk about, the whole world was buying the U.S. Reserve asset, right? And the Fed was cutting interest, was able to keep interest rate very low because inflation was really was falling, and that result in the relentless rise of gold. Now, if you look at this chart here, right? The most recent leg really start from 2019, right? And actually before the COVID-19, once the Trump got elected, before that, maybe I can talk about from 2011 until 2018, 2016. And one we want to say here is that, why we're doing all of this QE and the gold was not rising, and why? I always say that have a lot to do with the, first of all, I think in 2011, gold probably was in the bubble, okay? So it was the correcting of the excess. And secondly, as we all know, the money can only be created by two things. One is the government spending, and the other is the credit creation. the QE itself only increases the reserve and does not increase the money for the goods and the services, right? And what really changes, if you think about it, 2.0, is basically after Trump came to power, and they started the fiscal stimulus. Even the economy was doing well, okay, and obviously that was first offset by the monetary policy, but then, as we all know, in December 2018, the stock dropped like a stone, and the Powell pivot, and after that, gold really took off. Okay, now it had a dip during the pandemic time period, and then the rest of the history, the big rally came really after the fiscal and the monetary response from the central bank, right? So that will bring us the gold to the current price today. Now I zoom in here for today's price. So let's just look at this chart here. The white line is the gold price, okay? And the orange line is the real interest rate, 10-year real interest rate, okay? So I use the tips. In other words, is the nominal minus the break even, okay? And again, it's inverse scale. So it's on the right side inverse scale. When this is when this is go higher, it's basically the real interest rate diminish. When this is go lower, the real interest rate increase. Okay, so it's inverse scale. And if you look at that, basically gold and the real yield, they went in tandem. Okay, and last period of time, I think if you have following us for quite some time, and during the Russian war, when the gold break out, we were not quite sure how sustainable it is, because the Fed was really on the hiking cycle, and before you realize that, and the gold has significantly fell. And you can see here the real divergence really happens in the past 1 year. The real yield have went all the way from -1% to 2.5%, and look at the gold; it is still close to the all-time high. And I would say if gold have fallen the steps of real interest rate, and I would say the gold could have come back down to 1,000, right? And so that's almost kind of 40-50% of drop, right, of gold, right? And you can say that part of that is geopolitical premium, right? But it's very hard for me to justify that big amount of geopolitical premium. It could be, but I'm not quite sure, right? So that's why I actually think that gold is really overpriced. Taking away the geopolitical premium is very overpriced relative to real interest rate. So in terms of our valuations, right, we like real interest rate better than gold. Now we actually like nominal interest rate as well, because we think that inflation is going to fall. But anyway, that's a side topic here. And then one have to ask our questions, why the gold is priced significantly higher. There's only two things. One is that, the real interest rate will, to close this gap, there's two things can happen, right? One is the real interest rate will start to decrease and to catch up with gold price. So in that case, gold was leading. Or the gold price have to drop to catch up with the real interest rate. Or maybe it's a combination of both, right? So from that perspective, I think from valuation perspective, gold is not as attractive as the real yields and have a downside risk. From geopolitical premium perspective, and I think the things can get worse, and this geopolitical premium can expand. Now, if we look at the past hiking cycle, if we look at the history, it will probably be be a good idea to just review gold performance during the transition period from the hiking cycle to the cutting cycle, because we do think that we probably are towards the end of a hiking cycle. Maybe we are already at the end of a hiking cycle, and typically after the period of pause, the Fed will come back to cut. Now there's exceptions. And in the in the 1998, 99, after the pause and the Fed hiked the interest rate, I think our environment is drastically different than that time period, and we can discuss that in the future. But let's just say during this transition period, let's look at the history. So this is basically in 20 the gold and the Fed fund rates in 2018 and 2020, right? So when the gold already started to rise, when the Fed was about, Fed have another hike basically. So the gold already started to rise before Fed ended the hiking, right? One hike earlier, right? And then during the time when the Fed was pausing, gold went sideways and sideways higher, right? And when the Fed started to cut, the gold took off. And then during the pandemic time period, gold dropped when Fed cut interest rates significantly. And that is the liquidity shock. Okay, during the liquidity shock, gold will drop. Gold will drop significantly. And if we look at the history, in the 2005 to 2010, during the peak of a subprime crisis, you can see similar things as well. So gold actually was rising, started to rise already when the Fed was hiking interest rate, towards the end of hiking interest rate, right? And that was well in advance. And because of that move, I would say, when the Fed paused, the gold was sideways for a long period, for quite a period of time. And the gold took off once the Fed started cutting interest rate. And once the Lehman defaulted, right, we have a big drop. Fed basically cut interest rate to zero very quickly. But the gold actually have a big drop. And that is another liquidity crisis where gold got liquidated. Another way of thinking about this is also the real interest rate actually at that time was tightened because inflation expectation have dropped so fast. And the Fed has not reacted yet. For that window of time, the real interest rate have actually increased. And if you look at 1999 to 2000 hiking cycle, I mean, that is slightly different. So when the Fed was hiking interest rate, gold have started to fall. Well, gold was falling, right? And gold only started to perform when the Fed started cutting interest rate. I would say I think the last two period of time probably is more comparable for us, and that is because the monetary policy, the Fed has made the monetary policy very transparent to the investors. So all the investors start to anticipate Fed reaction function well in advance of a Fed actual, kind of a move, right? And during that time, basically everyone have to guess what the Fed was going to do. So if you use that analog as an example here, and I would say, because we are towards the end of the hiking cycle, and gold probably will go, go higher or sideways higher, and because once the Fed really start cutting interest rate, in the absence of liquidity crisis, gold will accelerate. And if there is a liquidity crisis, gold probably will drop, and that is probably the final end of the decline. That's probably is the bottom where you can buy for the longer run, and because the physical response and the monetary response will come after that. So a decisive turn of physical response and the monetary response will be the decisive bottom of gold for the long run. And how to navigate from this time period until that time period is a question mark. And obviously history is different, every time. Like we said, there is a geopolitical premium, that here is very subjective to everyone's, everyone's estimate and deliberation, right? I can actually show let me just pull up a Bloomberg chart here, and we can actually show the gold chart in the shorter term. And so if you look at this gold price here, right, and we're really getting stuck in this range from 1600 to 2000, right, with the pivot moment, with the pivot price at 1800, right? So I would say if we break above 2000 and sustain above this level, and this can really accelerate to the upside. And obviously, one cannot rule out, longer consolidation within this area or even fall, because gold is overvalued versus the real interest rate by our work. But gold typically will rally when we are towards the end of the market cycle, and gold will really accelerate to the upside when Fed start cutting interest rate, with the risk of liquidation risk if there is a liquidation of the broad deleverage of financial asset across all the asset classes. So I think that will summarize my short-term views. Henrik, do you have any other questions? Is there anything else we should discuss?
No, I think this was very comprehensive. And actually, I think we're coming to the end of this episode now. So let me try and summarize your summarization, just so that we have it on record, right? So we agree that gold has limited intrinsic value in terms of generating cash flow, but gold is also firmly planted in the human psyche as a representation of value. And as such, one can argue, gold should be part of an investor's strategic allocation. Now, the current drivers underpinning this argument for a strategic gold allocation are the long-term outlook for higher inflation and a lower growth environment, the likely intensification of global strife, that is, geopolitical risks, a trend which may be with us for the long haul, and the initiatives by various countries to push de-dollarization, an effort that is linked to the geopolitical situation, and also this driver is likely to be here, to be with us for the long term. Now, Jim, in the short term, your views on gold have been adjusting, and currently you're kind of bullish. You believe that gold will start to rally once it is evident that we have reached the end of the hiking cycle, and that gold has the potential to rocket when central banks actually start to ease. However, gold could also be vulnerable in case of a broad-based asset liquidation, right? Now, as far as geopolitical premium goes, just note that this month, October to date, gold is up about 10%. And this geopolitical premium will probably remain both elevated and volatile in the longer run, depending on how global politics play out. So I think that's what you said, I hope.
Yeah, so that is a very good summary. I would just want to come back to correct a little bit here, is that I think the gold will start to rally when it's evident that we have reached the end of a hiking cycle in that sentence. I do think we probably have reached the end of a hiking cycle. And I do think gold will probably start to rally because of this, okay? So that's the main reason why I'm turning more bullish on gold. Now, my hesitation here is because the gold has significantly overpriced relative to the real yield. So I do not know how much is geopolitical premium and how much is the gold anticipation of the Fed, pausing and easing. So I think that's something that we need the market to tell us, rather than that we will enforce my own views on the market. But in general, that's a good summary. And so Henrik, tell us where listeners can follow us. Henrik?
Yes, sorry, I was on mute there. So yes, you can follow us by searching for Total Convexity in your favorite podcast app or on YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode is available. You can also follow us on X, which used to be Twitter, where we have the handle @TotalConvexity. And you can email us at totalconvexity@gmail.com. And you can follow our insights on Substack at totalconvexity.substack.com. We promise never to spam you, never to try and sell you anything, and not to expose you to advertising and marketing. All you will get is our honest take on the markets, right or wrong, and we'll try and make it short and sweet. Anything else, Jim?
No, that's it. So thank you, everyone. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. And this concludes the first, this episode of our podcast, Total Convexity. We will see you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.